Hello, everyone, and welcome to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today is Tuesday. It's March 15th. I'm Mike Bernick, and joining me today are Mike Larson, Kathy Lean, David Dukevich, Boris Schlossberg, and Mandeep Rai. All right, well, we've seen a nice rally in the stock market over the last several weeks, which has left the S&P a little bit on the overbought side. Of course, last week the ECB spoke with their own policy pronouncement, cutting rates further into negative territory, more monetary easing, which certainly injected some volatility into the markets. This week it's the Fed's turn to weigh in, and against that backdrop of what the Fed may or may not do, we have, as I said, an S&P 500 that's rallied almost straight up for the last several weeks. In fact, as of last week, nearly 90% of S&P 500 stocks were trading above their 50-day moving averages, which is an extreme overbought reading, very rare. So where do we go from here? Mike Larson, what's your take on it?
Yeah, hey, good morning, everybody. It's been obviously a heck of a volatile market since the start of the year. I mean, we've rallied here, about 200 S&P points off the low in just a span of about 3 or 4 weeks. But, at this 2010 level, we're basically only where we were in January. So we've traveled a lot of distance, both down and up, in the shorter sort of weekly time frame, but in a monthly time frame or a bigger picture, we haven't really gone anywhere so far in 2016. So kind of an interesting market environment. We had a lot of panicky moves in many asset classes in January and early February. Then we reversed on a dime, and everybody was euphoric. It's a crazy amount of volatility, and frankly, it's unlike anything we've seen, really going all the way back to the 2007-2009 bear market period. I mean, other than August, September, October, we kind of saw the same behavior. So the fact that very similar market trading patterns have happened just a span of a few months out after a period where we went many, many years with very little volatility and kind of a straight up into the right stock market move, outside of the one kind of, August 2011 debt ceiling debacle stuff, tells me that the market conditions, the credit conditions have really changed. We're in a different economic and market backdrop, a different volatility kind of regime or environment, whatever you want to call it, than what we've seen for the last 6.5, 7 years. So I think it just kind of backs up that view that I've had that the credit environment's changing, the market environment's changing, and that this kind of volatility is going to be the norm. And I think it goes back to what we saw again in the last bear market. The pattern of waterfall declines amid some kind of panicky catalyst, followed by overly excessive central bank or policy response, followed by euphoric bear market rally that runs out of gas because the underlying fundamentals haven't changed, and the pattern sort of resets. I mean, that's what we saw multiple times during the sort of 2.5, 3 year downturn before. And I think it's similar to what we're seeing now. So long story short, volatility is here to stay, and that's gonna be something you have to adjust for in your portfolio, because this isn't the same kind of environment we had from 2009 to mid 2015. This is a whole different ball game. Going forward, obviously, when it looks to policy, I mean, the ECB tried to throw everything but the kitchen sink at the markets the other day, and that kind of gave us, the first or the second leg of this rally. But then the BOJ, the Bank of Japan, overnight basically didn't do anything, so we had some disappointment there. Now you've got the Fed coming up next. I think it's unlikely that they will hike interest rates here, but there's some speculation they'll basically lay the groundwork for a potential hike at their next meetings if things don't noticeably change. And we've got a meeting in April, and we've got a meeting in June after that. So, this sort of market panic response or market panic behavior followed by basically panic behavior in the other direction when you get a central bank response. And then, the next crisis down the road, that crisis response crisis pattern is what I think, we really have to get acquainted to. And I mean, it opens up some fantastic trading opportunities for shorter term and intermediate term traders, but it can really wreak havoc on longer term investors because you see such, again, bipolar behavior, panic, euphoria, sometimes within the span of a few hours, much less days or weeks. So for longer term investors, this is an environment where I think you have to focus on higher yielding stocks that have high WICE ratings, that are in non-economically sensitive sectors, and that offer lower volatility than the market. So things like utilities, consumer staples, telecoms. Those kinds of names have worked pretty well for us and Safe Money, and those are the kinds of names that I think, they're somewhat insulated from all the shenanigans and BS that are impacting other sectors. They offer higher yields than the market, but not ridiculously higher yields, which are an indicator that the company underlying those yields probably can't pay them. So you want dividend, you want a nice dividend, but you want dividend sustainability as well. And that's kind of the strategies I'm looking at for this market. Again, just a new environment, and it requires, adjusting on everybody's part.
All right, thanks, Mike. Interesting insights. Certainly, we have seen a lot of up and down volatility, much sound and fury signifying nothing, perhaps. Kathy Lean, in speaking of sound and fury, we saw some incredible moves in the currency markets on the back of the ECB announcement. Just a lot of really volatility up and down. What do you make of it all?
Yes, we did see basically a 4-cent move in the euro, which, and also it moved in the complete opposite direction than what most people anticipate. You think that the ECB, as Mike said, would, basically pulled out all the stops. You would think that, all of their actions would really diminish the value of the euro. But instead of falling, the euro actually increased. And I think this reflects a market that is thinking ahead. And they're thinking not just about what is happening today, but what's going to be happening in the next 3, 6, 9 months. And in the case of the ECB, the Mario Draghi, the head of the central bank, came out and said, we're done. Whether or not we're done forever remains to be seen, in my opinion, because I think that by doing everything now and suggesting to the market that they've pretty much run out of ammunition is a very dangerous endeavor. But they told the market, they're pretty much done, and the market realized that, in an environment where other central banks could still lower interest rates, it was a breath of relief, and there was a lot of investors who were short euros ahead of the announcement, and now we're seeing a bit of short covering. So this leads to the question of the Fed, as Mike mentioned. We've got a very big, high-profile FOMC meeting this week. It is one of those quarterly meetings where we get a lot more than the monetary policy statement. So I think no one expects the Fed to raise interest rates on Wednesday. But once again, everyone is going to be thinking ahead. They're going to be thinking ahead about what happens in June, what happens later this year. The key is, will the Fed leave the door open to additional tightening? And we think they will. I mean, there's no fewer than 5 things, in our opinion, that has happened over the past week that makes the Fed smile. I mean, that includes, they're probably very happy with the recent recovery in stocks since the January meeting. They're very happy with the rise in oil prices, which, takes a lot of the downside risks of inflation, off the table for the time being. They're very happy with the significant amount of easing that the ECB provided, because that also lends support to equity markets and risk appetite. They're very happy with the jobless claims numbers and the improvement that we had last week and the general improvement in the unemployment rates. And they're also happy with the fact that the U.S. dollar has weakened since the last meeting, which also boosts inflationary pressure. So there's a lot for them to be smiling about. Of course, the U.S. economy is in no way, shape, or form healthy, but it's enough for the Fed to leave tightening this year on the table. And I think that is what the market, that's what investors are going to be focusing on come Wednesday. And that also means volatility, just as we saw with the ECB meeting. You have a knee-jerk reaction to initial headlines and the shock of whatever the Fed decides to do or decides not to do. And then you have everyone thinking about what comes next. And that's what causes the volatility in the markets. We also have a lot more volatility in other currencies. Brexit, which we've been talking about for weeks, has come back to the forefront. We had some recent polls released, and it seems like, there's more in favor of leaving the UK than staying in there. We think that regardless of whether they leave or not, there's a lot of uncertainty that hasn't been priced in. And, the referendum is getting near, and it's something that investors need to seriously consider. So when the markets bottomed out in February, it bottomed out in large part because the investors felt a sense of complacency. and they felt that, things could not get worse, and perhaps it's time for things to start rallying. But I think that in the next couple of weeks, months, that you're going to see negative headlines once again, and that could reinvigorate the nervousness and anxiety in the markets, just as we're seeing a little bit of that today. And I think, that's going to come back to the markets and create more volatility and maybe even lead to more weakness in equities and currencies.
All right, so expect more of the same, a lot of up and down volatility. That's really been the hallmark all year. Thanks, Kathy. Great insights. I appreciate it. Let's see. How about Mandeep Rai? What's your take on the markets here as we get into the thick of earnings reporting season?
Hey, good morning, Mike. Good morning, everybody. Yeah, so I agree with everything that's already been said. We've had the lowest volume yesterday so far this year, and a single trading day of 6.3 million shares traded, way below the average for 2015 as well. And I think we're just kind of looking at a holding pattern, kind of waiting for the Fed's conference and the forecast tomorrow, which has notoriously been overly aggressive and just flat out wrong. The futures, the CME futures, have been a better indicator, and they're suggesting since the market rebounded some and the economic data has been a little bit better than expected, we have about a 75% chance of a rate increase, of a single rate increase in sometime this year by December, 50% chance of it happening in June. Excuse me. But because commodities have rallied some, wages are starting to budge, unemployment is still low, there is some inflation risks. I wouldn't call them risks, but more so the chance of inflation ticking up and getting closer towards the Fed's target. And because of that, I think we have an upside risk to rates and potentially more hawkish language from the Fed, which, judging by the market reaction to Draghi's never-ending easing program, where he extended and expanded policy in Europe, they cheered on Draghi's policy moves. We could potentially see downside risk to the market come the day after the Fed announcement and the conference. I think the initial reaction, you just take that with a grain of salt, but I think you have to wait and see how the overseas markets react overnight, and we'll see what the follow through is in the morning on Thursday. So that's the immediate reaction, and I think some of the lull in volume will dissipate as well. I think everyone's kind of waiting for that to place their bets. So the negatives that we've seen have improved some. We just talked about commodity prices. Oil prices have improved, but there was an interesting article today from in the Wall Street Journal about CEOs of E&P companies. Those are the exploration production companies that were saying that they won't be able to ramp up the production the way that they would like. As oil prices fell from $110 to $26 a barrel, production fell very, very slowly, and it's because we are one of the most efficient producers, not in terms of cost, but in terms of being able to extract more out of given wells for longer periods of time. But because these E&P companies have laid off workers, and they've had balance sheet impairments, they've got strapped financials, they're suggesting that they could be even slower than the decline to raise production if oil prices were to improve. So that kind of means that when we finally see the weekly production numbers echo in what we're seeing in the drop in rig counts, oil prices will probably rally, and we're going to get a transition from a supply glut to a supply shortage in the span of a few months, and you're going to see that reflected in the price of oil very, very quickly. But that's not happening just yet. We're starting to see very, very small signs. There's not enough to move the price of oil on a fundamental perspective, so we're still prone to the rumblings out of OPEC, non-OPEC countries, on a day-to-day basis, what's going on with Iran, and the tentative agreements that they're trying to achieve on production freezes, not even cuts. But I do think the bottom is probably in, and next downside support is around 34 3/4 to 35. That's the point where I look to add more exposure. In terms of the market, in terms of earnings season, yes, we've had a disappointing decline in earnings. We did beat lower expectations by a couple of percentage points, but we've had a 6.8% decline for the fourth quarter. First quarter expectations are lower as well. I think we're looking for 8.1% decline in earnings. So that'll be the fourth quarter in a row of earnings declines. And even though those expectations are probably worse or lower than what will ultimately be achieved by companies, it's a lower hurdle for a beat. But on an absolute basis, it's kind of problematic because the spread between forward EPS and the S&P 500 is near its largest amount since 2006. So even though the market's trading at a reasonable multiple around 6.1 forward earnings, it's getting pricier compared to the ability of the companies in the market to be able to generate earnings. So that's problematic, and I don't think that's going to augur for higher prices and a breakout to the upside. I think that we may see the 1 to 2% or so to the upside as investors and money kind of chase that last dollar of upside. But I still think that you need to be cautious, and I think the risks are to the downside. So we'll see what the Fed brings, and we'll see how those the earnings situation develops.
All right, thanks, Mandeep. Yeah, indeed, with the earnings recession continues. Let's see, Boris Schlossberg, let's get your views on some of these crazy volatility we've seen in markets recently.
Well, I think it's interesting. The problem, I think, with the crazy volatility is that the data is reflecting this type of uncertainty. Today's retail sales, for example, kind of half full, half empty look. Part of it was a little bit better, part of it was worse. Revisions were worse. Still, I guess, push comes to shove. I think the problem with the Fed as far as tightening, they want to tighten. I think they want to believe that the U.S. recovery is robust enough to sort of normalize policy. But they're also running up against the electoral season, which means that their last chance to tighten will probably be in June, at very last. So it'll be interesting to see. Everybody's going to be watching Janet Yellen's rhetoric tomorrow, and just to see if she shrugs off the sort of mildly weak consumer numbers that we're seeing and plays up the relatively robust labor numbers, or whether she actually sounds a lot more cautious. At this point, I think the market is uncertain, but leaning a little bit bullish on the Fed, meaning leaning a little bit hawkish on the Fed going into the meeting. But I think it's going to have dramatic impact on currencies once she resolves, because if she does disappoint and sort of says, we're probably going to hold off, and because if she holds off now, it's essentially holding off until after the election. You'll see dollar yen probably drift all the way down to test its lows of 111. If she does signal a more hawkish posture, if she does signal that there's a very real possibility that they could add another 25 basis points to the curve by June, then the tone will be a lot better. And I think it's reasonable for us to see 115 over the next week or so. So it's kind of like a 111, 115 trade, very much a straddle, depending on what she says. To me, that's going to be the most important variable this week. Nothing else really matters. The data is inconclusive, and therefore it's really policy judgments that are coming into play. You see policy judgments really driving everything in the currency market. Overnight we had BOJ, which decided to hold off on any further additional policy and even not enforce the negative interest rates for retail money market funds, and that had a negative impact on dollar yen. It strengthened yen. So I think in a world where there's no definitive, clear, fundamental data at this point, the market is very much relying on what the policymakers are going to be doing, and that's what's going to be causing all this volatility as we go forward.
Interesting. Thanks, Boris. I appreciate it. And let's see, David Dukevich, what's your views on the markets here?
Hi, Mike. Hey, everyone. Well, let's start with gold. We've seen gold break almost back to new highs again last week on the year. And now we've kind of drifted lower again. And I would say this is more of just a consolidation type pattern right now. I don't think we're going to have a big break. and go all the way back down to the lows that we saw back in December of last year. But I do think there is a pullback. Like any normal market doesn't go straight up forever. A healthy trend needs to pause and consolidate, move sideways, even move a little lower. And I do think we're starting to hit that phase a little bit right now of this move in gold. So I do expect to maybe retest that 1,200, maybe 1188 level. It could go a little bit lower than that, but even if it does, we're still all on that kind of normal pullback where we're still showing that we should still continue to see gold move higher throughout the year. So I don't think we'll get too much of a pullback, but I do expect a pullback coming in the near term. We should probably see the same thing with silver as well. When it comes to some of the other markets, natural gas has pulled back and actually broke to new lows last week, and it got down to about between the 160, 165 range. We're now back up to about 185, 186. So that's showing some positive movements, and we're also starting to head into a seasonally time period where natural gas prices should move higher during the springtime here. So I do expect to see us move higher from here, maybe get to the 195 to the $2 level, at least in the near term. Could even potentially break a little higher than that, depending if we get some momentum going right now. As Mandeep mentioned already with oil, we are seeing that same thing. We've had a really strong move higher. We are starting to pull back in a little bit of a consolidation move right now. We potentially could move a little bit lower even from where we are now at around the 36 level. Even if we move back to the $33, $32 level, if we hold there, that would still be okay. We could still see this market move higher again, as long as we don't break to new lows, which is around that $26, $27 range. So if we can continue to hold and just consolidate here, I do think the lows have been put in for oil, so I do think we'll be heading higher. Some of the other commodities, like the grains, also have been consolidating and actually look like they could start to be ready to break out from here. We'll have to see if they can get this move higher, or do we just kind of stay in this trading range we've been. But if we do break out, we could see a pretty significant move, because we are potentially running into a new weather pattern that would be bullish for the grain prices, both corn, soybean, and wheat prices. Well, that would be the opposite of what we've had this year of the El Nino. It would be the La Nina effect that we could get come later this summer, which would be bullish for prices. So if we do see that materialize, we could get a pretty significant move in the grain markets right now. Equities, as we've mentioned, we've kind of been stuck. We ran right up into that 2020 level on the S&P, and into some resistance there. That's also right around the 200-day moving average. We haven't been able to break that. Right now it looks like, the next move's probably going to be down, barring any Fed speak this week that really changes that. So I would expect to at least go back, test that 1950 level, which was the previous point that we really needed to break through. If we do break back below that 1950 mark, then all of a sudden we're looking to get back to that 1900, 1890 level. And then from there we could even go further and kind of retest where we hit the lows earlier this year. I'm not so sure we'll get to that point, but we'll have to wait and see if we can hold any of those support levels.
All right, thanks, David. Appreciate it. Well, that wraps things up for this week's Squawk Call. Great insights, gentlemen. Thank you, and be sure to tune in again next week. Until then, I'm Mike Bernick from Money and Markets. Good investing.